Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's Deal Deep Dive episode, we're joined by Darin Davis, founder of Club Capital. Darin's going to share a very interesting story about a new construction deal that started in 2008 and sold in 2022. After 14 years of holding this project, it is to date one of their best deals they've ever done, but it definitely did not start out that way. Now let's welcome Darin Davis. All right, Darin Davis with Club Capital, the founder of Club Capital, is joining us from Texas today on the Westside Investors Network podcast. We're going to dive extremely deep into what sounds like a hairy deal from a few years ago now. It's a deal out of Austin, ground up development. Before we get into that, Darin, thanks for joining us. And I want to hear a little bit more about Club Capital and your real estate career to this point.
Yeah, no, thanks, Trent, for having me. I really appreciate it. A little bit about me. I actually started out probably like a lot of people graduating from college in the business school. I went into sales and marketing. And I quickly realized that I needed more challenges, and I kept raising the bar for myself. And I would work somewhere for 3 or 4 years and go take on another challenge and another challenge. Well, that led me from Oklahoma to Texas to DC, anyway, a couple different places, but I landed out in San Francisco, and I was out there working for a software company. And I looked up one day and I said, man, I am on the road Monday through Friday. I don't control my life. I make great money. I was kind of like addicted to that, but I could tell after 5 or 6 years, I go, this is not the life I want. And I didn't know what I wanted, but I wanted more control. And I literally had no idea that I would be going into real estate. I literally happened to stumble upon a conference in Arizona that I had heard about on a radio show. And on a whim, I went to it, and I walked out of that conference and I said, I'm going to go quit my job. I'm done. There's this thing called syndication, which I thought like I was part of the mafia or something. I didn't even know what a syndication was. And there was this thing called passive cash flow. Well, what is that? But spending a 3-day weekend there, I learned about it, and it literally, the switch had been hit, and I went back, and the girl I was dating was then going to become my wife a year later. We talked about it and said, you know what, we're both from Texas. The market in Texas is probably better for getting married, having kids, and doing real estate. And we moved back, and we literally both started together working on what would be the next 25 years of our life, and doing, capital raising, syndication, and it's just grown and grown and grown. So best decision I ever made. And I actually didn't even know that was the decision I was going to make that weekend. I had no idea, but I know I was looking for something different. So,
and unfortunately, Darin, you're not alone. A lot of people get their start in real estate when they kind of get that realization of, I don't want to be working 9 to 5 for the rest of my life, and I want some more control over my schedule. And that's, I think, I've heard plenty of examples of how people get into real estate, and a lot of them revolve around wanting to control your schedule. And there's so many different avenues that one can take when it comes to real estate and, controlling their schedule, building a life that they want to live. So unfortunately, you're not alone there, but it's a common occurrence, and it's obviously led to Club Capital and everything that you've achieved in the last 25 years, like you said.
Yeah, I can't tell you it. there's a whole story behind that whole thing in control, but the events that happened later on in my life, the sheer fact that we made the decision to do that probably saved my family's, future. And not knowing that, we had no idea, but it just the sheer fact that we started that, executed on it, and keep going, it's been the right decision. So I'm looking forward to the next 10, 15 years. I'm also bringing my kids up into it. They keep asking me, Dad, what do you do? I said, easy, grasshopper. We'll get there.
So throughout your career, have you strictly focused on multifamily syndication, or has there been any other asset classes that you've explored?
That's a really good question, and I'll tell you. Like I mentioned earlier, I didn't really understand what a syndication was. So probably like most people, I started off with a few single family homes. Okay, and then I graduated to a couple of small strip centers, retail strip centers. And then I got all cute and thought I would do some land development. I wouldn't recommend that for people that aren't just really well educated in that. Didn't do bad, but it's a lot of work for a little reward. But then what happened is in 2007 or eight, we got challenged with a piece of dirt that we had bought, and the economic crisis, the great, recession that we had in 2007, 8, 9, it hit us, and we had to get real creative on what we were doing with this tract of land. And that's what launched me into multifamily, and not even knowing a lot about it, but I knew that I had to do something. I couldn't sit paralyzed. I just couldn't sit there and do nothing. I had to start figuring out something. Probably the best education I could have gotten, because I didn't have a choice. It was like, you go or you die. It was one of those where, and we went hard, and we survived, and it turned out being one of the best deals we ever did. So, and I think that's the one we're going to talk about today. And I'll share some of the details on that one as we go through this conversation.
Yeah, and that actually leads me to my next point is, it sounds like we're going to talk about this deal in Texas, land development, 240 unit multifamily property asset. I want to start from the very beginning of this deal, because you said you acquired the land.
Yeah.
Walk me through that process. Did you raise outside capital for it? Did you acquire the land yourself and then bring in investors for the development? Tell me about that.
Yeah. So what we were doing when I talked about, purchasing land development, I thought I was pretty smart. So we had purchased this 14-acre tract of land, and not knowing what build to rent was, but at the time, kind of the little shotgun homes. A friend of mine was an architect, and another friend of mine was an investor, and I was investing my own capital on this one. But what we were going to do is do these little garden home lots, just house after house after house. And we had it designed, and I hadn't even really thought about multifamily. And then the crisis hit. Okay. Then the capital dried up. And foolishly, I had gone out and purchased the land without having everything ready to go. Now, I did have a term sheet from a large lender, which eventually went out of business, but I thought that was good enough so that I could move forward. So I went ahead and purchased the land. Crisis happened. The capital source pulled the loan. They said, we're out of business. So I'm sitting there with a standard bank loan on this land, and I'm going, nobody's lending, nobody's building, everybody's sitting on their hands. I have a lender that's meeting with me weekly saying, you better figure something out or we're taking your land. Oh, and by the way, we don't want your land. So you're gonna figure it out, because land does nothing. And it was at the time, a really, what I want to say, it was a part of Austin, South Austin, that had not regentrified yet. And I have photos, I kid you not, of, there was dog fighting going on there. There was chicken cockfighting going on there. There was stuff going on. It's in a bad part of Austin, but you could see the way that the roads were going, and you see the corridors, and you could see the growth, and it was going to happen. And we took a chance on it, but you would have looked at me as an investor and said, "Are you nuts? I'm not doing anything." And that forced us to really, kind of do some creative things on the deal. so that we were able to do our very first multifamily. And no, granted, we pulled in a developer and a general contractor, and we got some help like that, but we were still on the hook financially for everything. But it was the land. So what ended up happening is we met some guys, the developers that had done some HUD loans, HUD insured loans. I don't know if y'all ever talked about, 221(d)(4) HUD loans. Well, it's a government insured loan, which gives you better leverage. It gives you a longer amortization period. And at the time, HUD was trying to place money for housing because housing had virtually stopped in 2007 and 8. So in 2009, we went to them and they said, look, we're interested, and we were saying, what's the but? You have no experience. Okay. You guys are brand new to this, and you've got to have somebody on your team that's stronger than you guys. Well, talking to my development partners, they went and found me a general contractor who had done a dozen more of the HUD deals. He joined our team. The developers had done several HUD deals. They joined our team. So we went from nobody with HUD experience to 2 people with HUD experience. And then we were looking at how do we get capital, right? Where do we get the capital? And at the time, the city of Austin had just developed had gotten approved for a general obligation bond. So what that was is if you would provide so much affordable housing and use some of this bond money, we'll eliminate your property taxes. So we went from building a market rate deal in a market rate environment to having to get a GC that had experience, a developer that had HUD experience. We got bond money from the city and we put it under a program that gave us some affordability, like half the units had to be affordable, but it got rid of the property taxes. So when you look at the city coming in and the experience from the developer, the GC, I said, we like this deal. We want to be your lender. And so we were able to get construction loan. We were able to get a few $1 million in bond money. And then the only thing I had to bring was another, it wasn't that much at the time, 4 or 5 million common equity from our investors and myself. And I had a big chunk of that at the time, and we were able to put the deal together. And when we did it, we were the only new project that came out of the ground or opened up in Austin in 2010. We opened up in January of 10. And you can imagine when no new product had been built for 2.5, 3 years, our rental, we had 240 units rented in 5 months, completely rented the whole thing up in 5 months. So it just was, and it worked out. And all we did, we got creative. I mean, we had to go find resources. We had to go find capital. We had to find the right people. I didn't even know anything about HUD loans, had to educate myself on that. And sure enough, when we thought it was the deepest, darkest time financially and housing or just everything, we ended up having one of the best deals we've ever done. And we've held it for 14 years.
So I got a couple of questions after hearing
Sure.
the beginning aspect of this deal. So obviously your initial plan was to develop single family homes. That went out the window and everything fell apart.
Correct.
How did you did you basically have to re-underwrite the entire project when you made that decision to switch?
Well, I knew you were going to ask me this question about underwriting.
Yeah.
We didn't have a choice. Okay. There was no underwriting. Okay.
Yeah.
It was either lose everything today. All right. Or put some more money in and let's take a chance. And I had this conversation with my wife several times. She's going, you're going to put another 700 grand into this. I said, either we do that or we lose, the 2 or 3 million that's already in there. And I said, we have to do something. Okay. And we made the choice to go. All right. And we just, there was no underwriting. It was survival at that time.
Right.
And maybe a lot of your guys that'll listen to this show might not have like direct knowledge and experience about what was going on in 7, 8, and 9, or 8, 9, and 10. But it was some tough financial times. So we made the decision. And again, if you look at it, I'm in one of the best cities for growth in business, education, government. I mean, we're in a really, I think we're very lucky. Everything that we have here in Austin, it's proved itself out over the last 15 years. And I could see where the growth was going, and I could see the net migration that was coming here. But we had no idea how to underwrite that when there was no comps, nobody was doing anything. I mean, it was dead. And we worked together, had a great team, and I wish I could say we were super smart, but we had to just figure it out.
Yeah.
There's going to be times in your life, everybody's going to listen to this. The underwriting you throw out the door. You got to say, hey, my experience, my career, my family, my friends, we're just going to have to do this and trust everybody to go do it. Then that's not all the time, but it's going to happen to you one time in your life, and you're going to have to take that step and move forward. And that's what happened to us at the time. We didn't have any choices.
So next question is what was the total cost of this project from, obviously buying the land to getting it built and completed?
No, don't laugh, okay? You promise? So there's the laugh. Everything we did for 240 units was 23 million on the high side. It was low 20s on that. That same property today would be probably around 55 to 60 million. So yeah, to do that, to come out of the ground, and build that today. So just the, replacement cost alone is, there. But I'll give you an example. Back then, talk about a general contractor. If that's your business, when that guy came on as my partner, his fees were 30% less what they were just, 2 years prior. He needed to put people to work. He needed to put capital to work. He needed to just go. So we got a good deal on it.
And obviously, we already talked, there was no hard underwriting done, but when you started getting into the project, did you have a sense of what you thought the completed project would be worth at that time?
Oh gosh, no. This was my first No, I know. I'm sorry I don't have like this, oh, I'm the greatest student and I'm due diligent, but we got into this thing, and I mean, it was necessity. And I knew here's what I knew when we had a great deal, not good, great. When we leased the entire project up in 5 months, okay? At ask, I was going, we completely underestimated our price. And so we were able to increase pricing immediately. All right. And the thing that really helped us, and we're in a similar situation today, and I'll explain that.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
But we went almost 3 years with no new construction. So there was zero supply. And so in 2010, 11, and 12, rents just hockey stick, valuations just hockey stick. And they kept going until about 19, until about 20, maybe even 21. And it starting to flatten out. But because of that 2.5 to 3 year no new supply brought on, well, we still had people moving here. The net migration was happening, the jobs were happening, but everything got just out of control in a positive way for us. And I saw our rents do this, I saw our valuations do this, and we were able to refi that project twice and pull out, because we had the debt service coverage on it, we were able to we pulled out millions for our investors a couple times. And I think if you talk to any one of our original, 16, 17 investors, they would probably tell you that's one of the best investments they ever did in multifamily, or maybe almost most all investments. But we're kind of in that similar situation. I don't think there's going to be like this big collapse that we had in 8 and 9 back then. But you're seeing this. I mean, our permits and construction starts year over year are down 70% here in Central Austin. All right. Well, granted, they were a little high, but let's just say they're, it's half that. Well, we still have a net positive migration coming in here, and we still have new jobs coming in here. Well, I think between us and Florida, we're number 1 and 2 in the nation, percentage and whole numbers. But we're going to see, I think, 24, 25 start to bottom. And I think 26 and 27, we may not get the hockey stick we got in, 10, 11, 12, but we're going to have a nice run rate, I think, starting in 26-ish, where you're going to start seeing rents start trending back up, because we're not building right now. We're building, but we're not building anywhere near what we're going to need in 5 years from now.
Well, and that's a pretty hot topic across the country right now. It's just given the current situation in March of 24, building has seemed to slow down in a majority of the markets. And like you said, rents, I mean, in our market locally, rents were going down in the last 18 months. And now we're starting to see them, stable out and trend upwards. And but we still don't have any building here either. So I think that's a common occurrence in a lot of different markets right now. So I'm in agreement with you. I think we are going to start seeing that rental rate trend keep going here in the next few years. Yeah.
And I would say, and you probably know this, I mean, we have over $600 billion of loan maturities between 2005 and 6, 650, I think. So and I don't think that there's going to be significant interest rate changes this year. I mean, it's not going to move the needle that much. Okay, if we get 50, 75 basis points, big deal. But you've got these loan maturities, because these valuations are still, lower valuations, higher interest rates, flat rents, leverage is low. I mean, that's just a tsunami for a developer today with a loan maturing in the next 24 months, and that's why we pivoted our business model. Our investors were like, hey, y'all aren't doing any new development. We understand why, you're not funding any new development, but that's where, we said to the guys, look, we're going to focus on pref equity, and preferred equity hasn't even been a topic of discussion for the last decade plus, because you didn't need it. But these developers today that have loans maturing in the next 3 years, they need that rescue capital, to get through the next 2 or 3 years. And that's where we've pivoted our business model from an equity group. And we're plugging in those pieces of equity today to help those groups get through to the goal line, which we think the goal line, 2 to 4 years from now.
So and I do want to circle back to that, but with this Austin deal, 240 units, yep. What's your end plan for it? I know you've refied twice, been able to pull capital out. Are you just going to keep holding indefinitely, or do you ever plan to trade it into something new?
Well, we just sold it 2 years ago, right at the top of the market. Okay. So I'd say we were fortunate. There was a lot of, it was a feeding frenzy here in Austin for about 4 years. When you're getting trades in the 3 cap rates, the valuations are high, and it was time to sell. So we did really well on that. But here's what I learned on that. I'm not going to say, a lot on the front, because we were forced into that. But what I did learn, and I have a couple of my own personal assets like this, but I don't be so excited to sell, because recreating an asset when it's a good one is really hard. Look at your refi options, because quite frankly, if we weren't in a syndication model where I had investors that said, hey, we're ready to exit and all this, I probably would have held that till today and keep going, because of my replacement cost, cash flow, I'm just everything. So the thing I would say is, we sold it, we did great on it, but I I'm in the process right now. The assets that I look at, I don't want to go, lather, rinse, repeat. I want to be able to hold that asset, refi it 4 or 5 years, pull that tax-free money out, hold it another 3, 4, 5 years, do the same thing. So that's a model that we're really focusing on. We did a few assets like that. All of them were incredibly successful. But when Austin was hitting that peak, this last 5 years, the numbers were just so crazy. We said, man, we've got to take money off the table. And we did. And now I'm sitting here going, if I could, woulda, coulda, shoulda. But you know what? We made money. I'm not going to complain about that. But we are going to look to go through that model like we did at Retreat at North Bluff, the Austin asset, and take a more of a 10-year approach versus a 3 to 5 year approach, because it's really hard to make sure that you're making money every time. And we have a lot more control under that 10-year model of refi and go again and refi and then go again. We have a lot more control and a lot more surety that we can, make money for our investors.
Absolutely. And that actually leads me to my next question. You kind of already touched on it, but with Club Capital, what are your goals or I guess strategies going into the rest of this year and 25 and 26?
Yeah. Boy, we made this decision about a year and a half ago. We decided that we couldn't make the numbers work. So it's not like we decided. The decision was made for us because we did good underwriting, Trent. We were underwriting the assets. Okay. So we would look at it and we'd go, we can't make anything pencil. What do we do? Well, we already had 5 projects underway, and one of them's 90% leased, one's 75%. The next 3, they're all 3 going to come online about May. So we've got to go through that process, but we've got still about 2 more years of loan left on those. So I think we're going to be pretty good. 2 pieces of land we're holding. So we decided that we are not going to take on any more capital raising events for common equity to do development unless it's a very unique situation. So what we decided to do is we had a few of our friends, our developer friends that we've provided capital for, said, hey, have you guys done pref equity? And we said, no, but we understand it. And we just kind of looked at the landscape and the loans that were maturing, and our investors at the same time were saying, hey, we want more surety. We want more safety. We want more cash flow. We think we're in a window right now where we don't want to take a lot of risk. So we implemented a preferred equity model about probably October-ish of last year. Spent 6 months kind of working on it, talking to developers. And for your audience that doesn't know what that is, and it's real simple. You have your senior debt, which is your construction loan or your bank loan, and then you have your common equity. That's what we've done for the last 10, 12, 15 years. Well, we haven't needed preferred equity, but what that is because of the lower leverage and the higher interest rates, the developers are needing, or the sponsors are needing a way to fill this gap. And it's primarily developers, because interest rates when they took the loan out was 3.5. Now it's 8.5. Well, just a lot of things have happened. Leverage has come down. So we're giving them this rescue capital, and we come in right behind the senior debt, and we are ahead of the common equity. So our distributions of our capital and our contracted return are paid before the common equity gets their money and before the sponsor gets any of their promote or anything like that. So, give you an example. You have a $40 million bank loan, you'd have an $8 million pref equity, which would be us. And then you may have like 15 or 20 million of common equity behind us. Well, our 8 million is going to get to our investors, is going to get a 12% return annualized. It'll be somewhere between 2 and 3 years, typically. And then, we're coterminous with the senior loans. So when the bank says, hey, your loan's up, so is ours. So we get paid out, but we get funded before the common equity does. So we sit in a really nice position in a really safe, secure. Now, you talk about underwriting. On these deals, we underwrite each one of them as if we were going to own it. Okay, so because there is an outside chance we may own it. there's an outside chance that when it's time to go get that senior permanent debt, to get the permanent debt on it, that it's not going to appraise in value to cover all the common equity. And then we would step in and do what we could to take the asset and possibly not. Is that probable? Probably not. Is it possible? Absolutely is. We're not in a distressed market here in Texas, but we're in a discounted market for sure.
Yeah, and that's interesting that you bring that up, because I've heard and read stories recently on certain GPs that are having to, basically hand over the keys and say, that's that. We can't, the property's not supporting itself anymore. Here you go. In a situation like that, would you be excited about having to take that property? Or are you really focused on the current model that you just explained with pref equity and coming in as that rescue debt?
Well, I'm going to say both, because I'm not excited that potentially the common equity may not, get their full return. Okay. But am I excited to get an asset at a discount? Absolutely. And I tell my investors, and I've said this a couple times, but not here, but to a few of our investors, I say, guys, it's called rescue capital. We're helping these people out. Okay. First, let's just start there. Are we doing predatory lending? No, there's an old term called loan to own. We're not doing that. Okay. We're not going in thinking we're going to own it, but we're underwriting it, and we're only providing equity to assets that we could potentially want to own. So I'm not going to go to somewhere in Columbia, Missouri, where I have no knowledge of the market and start working with somebody that I don't know what's going on. We're going to stay in Texas and Florida in our markets that we know. The economics look good. Everything looks good for where we are. But I said there's a kind of a catch-22 to this, because I said it's kind of like we're the Trojan horse, but with an olive branch. When you think of the Trojan horse, you're thinking, oh God, they're coming in to slay us. We're coming in to say, hey, we're here, we're inside, we've got a front row seat. You're paying us to get you out, get you to the next level. But we're getting to watch how the asset performs, how the property management's doing. So in the event that there is an opportunity for us to come in and take it over or buy it, we're there. We already know, we know the numbers, we know the underwriting, we can execute. So do I think we'll pick up an asset or two over the next couple of years with this model? Absolutely. And I look at it, and we're going to get paid to have that front row seat. Our investors are going to get paid to have that front row seat. So that's the way I look at it. And we are going to stay in our market. We're not going to get outside of our guardrails. So we think it's a great opportunity for about the next 2 or 3 years. And then I think the pref equity model is not going to be near as popular or as needed, by 27 or 28, maybe 28, 29.
And last question about club capital. When you guys are looking to invest in this fashion, are you looking at new construction development, or are you looking at pre-existing, or both?
Right now, we're only looking at new construction, because there's a really big need for the developers here. So everything we'd be looking at would be in an Austin MSA, a DFW MSA. It would be new construction, and again, it would be something we would want to own. So we think that's the best opportunity for us, and we're not doing ground up construction, meaning like it would be rare. We could do it, but this is not one of those where we are going to say, hey, we're going to start this process right now. You don't even have any construction equipment on the site. These are going to be guys that are entering in the last 2 years of their loan, and they're 60% complete, 80% complete. Their interest reserves are starting to run low. Their contingencies are starting to run low. And we're going to come in and replace those. So it'll be, for right now, I don't see us doing anything but, new construction that is already been underwritten, has been funded by the common equity. The bank lender's already in there. Everything is already set up. And we're coming in to just fill that gap for, a year or two period of time.
That makes sense. Yeah. Darin, did I not ask anything, or did we not talk about anything that you wanted to talk about today?
I would tell you this, going back to the project that we talked about, Retreat at North Bluff in South Austin. You know, I would just getting creative. There are so many different resources and sources. If you think you're going down a path and there's no other options, there are. Okay. We had zero knowledge, okay, of what we were doing for capital outside of friends and family. But there's bond money, there's affordable housing opportunities, there's tax incentives. And if you get into that situation, if you're doing development, which is probably not a ton of people, but you can take that same lesson on anything, a single family house all the way up to an acquisition. There are options. And I would just say that, you know, we were forced to make just decisions and quickly, and we made them and we moved on. They weren't all great, but we learned something and we kept going. And, you know, when you want to get it done, it will get done.
I love it. Where can people connect with you or hear more from you?
Oh, here, I'm going to do my Carl Rove thing. You ready for this? Here you go. You got that? clubcapital.co, co/go. All right, clubcapital.co/go. And where I'm sending you is I'm sending you just to a landing page that's got a little bit of education material on pref equity, because I don't think a lot of investors, you know, passive investors have probably been involved in a lot of pref equity. And I think it's a great opportunity, you know, for the next 2 or 3 years. And then our website is clubcapital.co. And then you can see everything about us and our track record, our team, kind of what we do. But if you want to learn just strictly about the pref equity, clubcapital.co/go. Go.
Awesome. Darin with Club Capital, Darin Davis with Club Capital. Thank you so much for talking about your South Austin deal, sharing all the different red flags or hurdles that popped up during that project. And I appreciate you coming on today.
Yeah, it felt like a machine gun half the time, but you know, with rubber bullets. All right. So, okay. All right, Trent. Thank you very much.
Thanks, Darin.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.